Right now, silver is setting a textbook bull trap at the very edge of a breakout that could rocket this market to 81.25. Most retail traders are about to get run over. But if you know exactly where to wait and where to place your orders, this is a gift. There is one danger zone and one hidden opportunity today. I'll show you both, with 3 precise trade setups including exact entry, stop loss, and targets. Stay until the end because I'm giving you the one invalidation level that proves the trap is failing, and the sniper entry to ride the escape velocity. Here is your instant market verdict. Silver is in a powerful structural uptrend on the monthly and weekly charts, strong by signals across the board. But on the hourly time frame we are witnessing a high probability bull trap formation that will flush weak hands before the next leg. The session bias is a shakeout range, fading the immediate breakout and buying the dip into the support confluence. The invalidation level that proves me wrong and signals the trap has failed, that the breakout is real, is a decisive 4-hour close above 79.80. Write this number down. If we get a volume-backed acceptance above 79.80 today, the whole structure shifts from trap to trend acceleration, and you must flip long immediately. Until then, I am treating every spike towards 79.60 to 79.80 as a selling opportunity for a pullback, and every test of the 78.40 to 7800 zone as the hidden opportunity to position long for the real breakout. Now let's walk the chart exactly as I see it, time frame by time frame, so you understand why the moving averages and momentum are screaming caution at resistance. On the daily chart, silver is trading at 78.57, sitting right in no man's land between the 20-day moving average at 78.38 and the 50-day moving average at 78.67. Price is literally sandwiched. The 20-day is slightly sloping higher, which is constructive, but the 50-day is flat, and that flat 50-day often acts like a magnet, pulling price toward it before the next trend. We are just pennies below it. The 100-day moving average sits way down at 75.01, and the 200-day is at 66.84. Those long-term averages are rising, confirming that the underlying structure is unquestionably bullish. However, daily MACD is positive at 0.243, but the histogram bars are shrinking, showing momentum is stalling. RSI on the daily is at 50.48, dead neutral, not overbought, not oversold, leaving plenty of room for a move in either direction. That neutrality at a major resistance cluster is exactly where traps are born. Drop down to the 4-hour chart, and you'll see what has the smart money licking their lips. Over the last 3 sessions, silver has tested the 79.62, 79.80 resistance wall 3 times. Each time, the candle bodies get smaller and the upper wicks get longer. That is pure exhaustion. On the last push, price spiked to 79.80, printed a massive bearish engulfing candle, and slammed back below 79 in under 2 hours. That right there is the bull trap hourly structure the market is talking about. MACD on the 4-hour has rolled over with a bearish cross, though still above the 0 line, so it's a correction within an uptrend, not a reversal. The 60-minute chart confirms this with a series of lower highs since that rejection, and the 20-period MA on the 60-minute is now sloping down at around 78.90, acting as dynamic resistance. The 60-period MA on the same hourly chart is flat at 78.50, which is exactly where price has found temporary support. This tells me the 60-minute battlefield is clearly defined. Resistance 78.90 to 79.20, support 78.40 to 78.10. Now let's zoom out to the weekly and monthly to anchor the bigger picture. The monthly chart is a strong buy, with price above every major moving average and a bullish MACD that is accelerating. The weekly chart is also a strong buy, and last week's candle closed as a bullish hammer right on the 5-week moving average near 77.97. That level, 77.97, the 5-week MA, is now the line in the sand for the weekly trend. As long as silver holds above that on a weekly closing basis, dips are buying opportunities. The monthly RSI is 62, comfortably bullish without being extreme. So the big picture says we are going higher, likely to the VCPMI target of 81.25 and eventually 86, but the path will not be a straight line. That hourly bull trap is the market's way of resetting sentiment before the next impulsive wave. Here's what most traders miss. The highest probability entries come after these traps, not during the initial breakout. The hidden opportunity is to let the shakeout complete, let price sweep the late longs and maybe even run stops below 78, and then enter long near the value zone where institutions reload. Let's connect the fundamentals and cross-asset linkages that are driving the silver setup, because the narrative is everything. In the last 24 hours, the core news is that silver tested the 79.80 resistance wall amid bull trap risk, and the VCPMI indicator, a leading composite model, is specifically targeting 81.25 as the breakout threshold. That's not a random number. It aligns perfectly with the previous structural resistance from early this year. So the target is already mapped. The question is timing. On the macro front, we are seeing the US dollar index stumble. The DXY has failed to hold above its own 20-day moving average and is now drifting lower. That dollar weakness is a direct tailwind for silver. At the same time, gold, the fear architect, is consolidating just below its all-time highs, refusing to break down. When gold stays bid like this, silver eventually catches a violent bid as the high bidder play on the same fear trade. The gold-silver ratio has been compressing from the highs, indicating that silver is starting to outperform. This is a classic regime signal that a silver catch-up rally is on the table. I want you to watch the ratio closely. If it breaks below 85 decisively, silver will rip. Now the risk asset shadow. The S&P 500 is grinding near highs, and Bitcoin, the other risk barometer, is showing some divergence with funding rates turning slightly negative, hinting that speculative froth is leaving the system. That cleansing is actually healthy. For silver, industrial demand out of China is the additional driver. The Aussie dollar, the China proxy, has been ticking higher, reflecting better risk appetite toward commodities. So you have a three-engine thrust behind silver: dollar weakness, gold's fear bid, and reflation industrial demand. The bear side, however, is that real yields in the US have been edging up, which historically pressures precious metals. But right now, silver is ignoring that, and when an asset ignores bad news, it's a screaming signal of underlying strength. The 1 to 2 week directional lean is therefore bullish, targeting 81.25 initially, as long as the weekly support at 77.97 holds. The exact event that would invalidate this thesis is a weekly close below 75.80. If that happens, the VCPMI target is off the table, and we reassess. But until then, I am leaning heavily into buying dips. Now, most people will click away before this section, but this is where money is made. Keep watching. I'm giving you 3 trade setups, each tailored to a different risk profile, with exact numbers and risk-reward logic. And after the second strategy, I want you to type something in the comments. We'll test your read on this market. Strategy number 1, the sniper. This is the conservative play for those who want high probability and hate getting trapped. The condition is simple. Do nothing until silver pulls back into the high-value support confluence and proves its holding. That confluence sits between 78.40 and 78.10, which includes the 20-day moving average, the weekly value area, and the hourly 60-period MA. Here's the exact trigger. Wait for a 4-hour candle to close above 78.40 after a wick into the 78.10 zone. That shows rejection of the trap low and signals that institutions have absorbed the sell stops. Entry is at 78.45 with a stop loss at 77.85, just below the 5-week moving average and the recent swing low. The risk is 60 cents. Target 1 is the resistance cluster at 79.60, that's $1.15 move, giving you a 1.9 to 1 reward to risk. Target 2 is 80.60, the next major resistance, which would yield $2.15, a 3.5 to 1 reward. If price triggers your entry, move stop to break even once target 1 is hit. This setup is voided if the 4-hour candle closes below 77.20, because that breaks the daily structure and opens 75.80. So if we break 77.20, you stand aside. No trade. Strategy number 2, the active trader. This is for those who can read short-term order flow and want to profit from the trap itself before flipping long. The entry condition is a fade of the bull trap rally. As price approaches 79.50 to 79.70, watch the 15-minute chart. If you see a sharp spike that stalls and prints a bearish engulfing or a long upper wick with follow-through, you sell market at 79.45. Stop loss is tight at 80.10, just above the trap high. That's 65 cents of risk. Target 1 is the 78.40 support, a $1.05 gain, roughly 1.6 to 1. Target 2 is 77.20, the structural breakdown level, which would yield $2.25, a 3.5 to 1. But here's the active rule. Once target 1 is hit, immediately trail the stop to entry and let the remainder run with a trailing stop of 30 cents. This way you book profit and stay in for the potential flush. Why this works now? Because the hourly bull trap is fresh, momentum is fading, and stops are still resting above 79.80. Market makers often drive price just high enough to trigger those stops before reversing. You're aligning with that liquidity grab. Now, let's see how aligned we are. Type your silver range for tomorrow in the comments right now. I want the high and the low you're expecting. I'm reading them, and in tomorrow's video I'll call out the most accurate ranges. This helps you cement a plan. Do it now. Strategy number 3, the aggressor. High risk, high adrenaline, only for those who know how to lose small and manage risk like a hawk. This is a momentum chase on the breakout itself if the trap fails. The moment price prints a 15-minute close above 79.80 with expanding volume, you buy the breakout at 79.85. Stop loss is 79.40, just back inside the prior range. That's a tight 45-cent stop. Target 1 is 80.25, the VCPMI measured move, which gives a 40-cent gain, almost 1 to 1, but the real juice is target 2 at 80.60, yielding 75 cents for a 1.6 to 1. If the breakout is real, silver could slice through 80.25 quickly, so you can also use a trailing stop of 20 cents once above 80. Warning: false breakouts can reverse violently, so this strategy must be sized with only a fraction of your normal risk, because you are buying into strength right at the edge of the trap zone. Only execute if you can stomach an immediate stop out without hesitation. Now the risk management pulse. Never risk more than 1 to 2% of your account per trade. No open positions through high-impact news like CPI or FOMC minutes. Stops are non-negotiable. The market does not care about your hopes. If the level breaks, you're out. Here is what you take away from today's session. The single most critical level for the next 24 hours is the 4-hour close relative to 79.80. That is the trapdoor. If we close below it, the pullback towards 78.40 is in play, and that is your buy zone. If we close above it, the escape velocity toward 81.25 is activated and you chase selectively. Tomorrow I will be watching the U.S. durable goods number and any fresh Fed speak for dollar volatility, which will directly impact silver's breakout timing. But the real focus will be on gold's next move. If gold finally clears its own psychological barrier, silver will tear higher. And I have a full breakdown on gold and the gold-silver divergence in a dedicated video that is live right now. Check the end screen. Smash like if this analysis gave you a clear plan for silver today. Subscribe and hit the bell because I break down 8 assets daily with this level of precision, and you do not want to miss the next explosive cross-asset correlation that I identify before the crowd. I'll see you in the next one.